Hello and welcome to another episode of the MikedUp Show, where every mortgage has a story. This is the ultimate hub where hidden stories behind the mortgage industry come to life. My name is Mike Kelleher, and together we dive deep into the entrepreneurial spirit, which you'll hear a lot about today, strategic insights, and breakthrough innovations that built the world's greatest mortgage companies. So whether you're advancing your career or scouting for industry leaders, trying to get access to the information or people you see at conferences, or just exploring opportunities in fintech, prop tech, and how it relates to mortgage, you are in the right spot. So get ready to unlock the story behind every mortgage. Let's dive in. I want to dive in with our guest today, Jim Carroll. And Jim has really done the entire spectrum of the mortgage industry. Can you take us to, Jim, that point where you wanted to get in the industry and work for your father's company, which was very successful, and you were top salesperson, and he sat you down? What was that conversation like? Was it out of left field when he said, well, first you have to learn how to underwrite if you really want a leadership?
Basically, my father had been running Southeast Regional Mortgage Operation Banks for a while. Was ready to get back out in the independent mortgage banking world because he had saw DU coming on in the mid 90s and said that's going to be a game changer. And so, with his relationships with Fannie, he was able to become Fannie Mae's smallest independent seller servicer in the country. And he said, well, I'm going to need someone to help me. And I was finishing up college, going to school full time, working full time, and I was burned out and I wanted to take a couple of years off. My degree's in psychology, and I was going to go on and get a PhD in psychology, actually. And he said, well, why don't you, if you're taking a couple of years off, why don't you work with me and help me get this thing up and running? So I came on board in 96, a few months after he opened, and was there for 23 years until we merged it with a bank out in Nashville, Tennessee. I mean, you know how this industry is. I mean, once it gets in your blood, you just can't get rid of it. Plus, honestly, I was using my psychology degree every day, constantly having to read people, and try to juggle personalities. No, yeah, I essentially started out his assistant. Then one day, we used to have to I would physically carry the file down in a binder down to the local bank, to our warehouse lender, and get and to house the loan. And I remember sitting in the elevator, and I look over, and this kid had a blank 1003 in his hand. And I said, are you making a loan application? He goes, I came in to make a loan application. They told me to go fill this out and come back. I said, I work at a mortgage operation. You want to come back to my office and we can fill it out right now? He said, sure. And in 1997, I originated my first loan for Keith Hillerman, VA loan. Par rate was I had 10%. And since then, the rates just started going down until, of course, as of recent. So then after that, I realized, I thought, you know what? I saw the money I could make being an originator. I thought, Dad, I'd like to be an originator. And he said, well, son, he goes, what do you think your hours are? I said, well, I don't know. We're open 8 to 5. He goes, wrong. Real estate's not done 8 to 5. It's done after hours on the weekend. And so I went down that road, did become top producing loan officer at Carroll Mortgage, doing about between 2 to 3 billion back then. And my average loan size was close to 150. So it was a lot of units, and that was before LO comp. So I was making real good money. And I was walking around thinking what doesn't stink. And my dad calls me in his office one day and he goes, son, I'm sending you to Seattle, Washington for some underwriting training. And I went, well, I'm a loan officer. And he goes, well, son, you told me you want to buy in this company one day. I said, well, yeah, Dad, I do. He goes, try walking to the office of an underwriter and tell them they're wrong on the interpretation of a guideline when you don't have the license to do it. You're going to Seattle. So I did go to Seattle, and then eventually got in ownership into the company and started taking over management and having to do things. So started basically and I know what his plan was. He really wanted me to be trained up and licensed as an underwriter to be in between ops and sales and take the pressure off of him. He could just focus on the major problems in underwriting files if one of the underwriters had a problem, and I could explain everything. Because that's the problem with most mortgage operations. The person with the communication doesn't have the time to explain it to everybody. They just say, well, we got to have it. And that's the worst thing a customer wants to hear. They want to know the why. So I did that with Carroll Mortgage for we did that for 23 years. And our claim to fame at the Lenders One conferences was that we were in business for 23 years, went through 4 HUD audits and didn't indemnify a loan, which is unheard of.
Yeah. In 23 years, that 4 HUD audits really stood out to me because you were at positions in production, secondary management, one of the best dancers I've ever seen. And you were always present at a lot of these collaborations. I think you were one of the first members of Lenders One originally. So people looked at you as a staple in the region you were in. And it seemed you never had the same tech everybody else had. So you guys were working on ways to innovate and differentiate, which was um, sort of a current theme into today. Where do you see these new technologies around underwriting? Do you think that is going to mean less fathers bring in Jim and make him go become an underwriter? Do you think they'll make him become some technologist to take over their company in the future?
Yeah, that's a good question. I mean, with AI, as y'all know, it's just been a game changer. I've been consulting on an AI software program that has been. I had told them, I said, if this thing works, it'll be a game changer. And then they started letting me beta test it, and it is truly some of the most amazing stuff I've seen. I will sit there, upload the 1003, upload the credit report, upload the bank statements, the tax returns, go to the other screen while I'm working on some stuff, and it spits out underwriting findings. And what it is, it's truly a highly trained set of eyes coming in behind you. Because, I remember one time I was pulling a file to underwrite, and I went, well, wait a minute, and I already underwrote it, and I didn't look through the software first to see what it flagged. And the software I'm using is Friday Harbor. I went to look at it, and I went, oh, there's 3 disputed accounts. I went, well, I don't remember 3 derogatory disputed accounts. And there wasn't, because I don't care about non-derogatory unless it's flagged by AUS. Well, I went and looked, and there was 2 non-derogatory accounts, one that was closed, always paid like clockwork. The other one, of course, it paid like clockwork. There was no problem. Now, it wouldn't have been the end of the world. Wouldn't have stopped me from getting a loan bought. But everyone, nobody wants to get hit on their knuckles with the ruler. And if you get that file gets audited, you'll get rid of it for it. So I went ahead and just need a letter of just explanation on it. So, but that's going to be interesting to see. I think we're in some very interesting times, because I think it's going to allow me as a startup to bring in less back office people to produce a loan, which, as you guys know, the cost of producing a mortgage now is way higher than it was 20, 30 years ago. So now it's about how fast you can produce it, how you got to get your costs down.
Yeah, it's interesting that you mentioned that, because when I hear about bringing down the cost, the only thing you can really do to bring down the costs is reducing the costs through people, which means that somehow you have to eliminate the checking of the checkers and then eliminating the checking of the checker's checker, right?
Yeah.
So pre and post QC, and using AI in order to go through the underwriting process, it sounds amazing. How do you think we need to go through some kind of iteration from beginning to end, from origination to funding to shipping, and then and so on and so forth in the mortgage loan process in order to figure that out and vet it all the way? I mean, did you just start doing that vetting out of the AI and the software for that?
Yeah, I think, if I understand you correctly, I think it's good to have it on the front end, due to the fact it's like I told as a consultant, I told them, I said, hey guys, your software can do way more than what you're thinking of. And they said, well, what do you mean? I said, well, I can give you these income calculation forms. Your system should be able to see, let's say the borrower only makes $2,000 a pay period, they're paid twice a month. Well, let's see, if, essentially, if they were paid 4,000, that's going to be what, 48 a year. So through June, year to date, they should be at half that number. And if your year to date isn't matching up what their pay period is, your system should be able to flag that as a stipulation that needs to be investigated further. And they said, absolutely, we can do that. And I said, because those things are easily explained, but usually not caught till it hits the underwriter's desk. And now you're trying to verify if there's a medical leave, if there's been a raise, things like that, which cuts down on noise. And that's the main thing, is the less noise on a file, the better the customer experience is, which is going to get you more referrals. And that's what this business has become about.
You've built a name brand, a reputation, really a last name in your community. We always talk about tomorrow's leaders start as local mortgage companies today. What type, as you're building a company for a bank, and you look at the next great IMB, probably with 12 people right now, what advice do you give them about building name brand in the community?
Well, that's key. And that's one of the things when I came to this bank with the proposal and was talking with them about building in the community. I said, look, I said, everybody wants the $750,000 loan, but there's the guy out there trying to get the $75,000 loan that lenders won't deal with because they economically, it doesn't make a lot of sense. But ethically, we should be helping those customers because the more you help in that community, the better your name gets out and the better it helps you spread throughout the community as being very reputable, knowledgeable, and an all around great mortgage operation. Because yes, you're catering to the top creme de la creme, which everybody wants, but you're also catering to the underserved areas, which desperately need it.
My first comment when you say that, by the way, I'm in California. And so and specifically in San Diego, where you have a lot of $700,000 mortgage loans.
Oh yeah. Oh no, that's the bottom of the barrel for y'all.
Yeah, yeah. Well, yeah, The median price for the area I live in is over $1 million for sure. And when you say that everybody wants a $700,000 loan, the first thing I think about with the larger loans is that the customer typically also is price shopping you as well. So when you say that the lenders don't want to do the $70,000 loans, I'm thinking they're going to be price shoppers no matter what part of the sector that you're going to be in. But I think there's less shoppers because they trust more in the originators. And so my question and comment is it for where you are at there on the East Coast, Southern East Coast, I'd say, are you, because of the AI, do you think you
Midwest.
can create? Yeah. Okay. Well, yeah, even better. Do you think you can create more efficiencies and more profitability per unit then as a result of your AI? And whether it's a $700,000 loan or a $70,000 loan, actually, could it be more profitable in what you're doing today?
I believe so, yes, because once again, it all these technology softwares coming out, whether they're using AI or just as technologies that were already there, um, essentially what you're seeing is it's allowing you to streamline the process and who all's involved in the file. And then the other thing is everywhere I've been, I've always thought you need to run a mortgage operation the way that my family's business was run. We A lot of people in the mortgage business believe you need to be a widget maker. Essentially, you're a processor, you're an underwriter, you're a closer, you're the loan officer, you're QC. I believe everyone should be cross trained for several reasons. Number one, it gives you to be in the. Anytime someone's come to me about wanting to become a loan officer, I'd say I would learn the back room first because then number one, you learn noise in, gets noise out. Number two, you also get appreciation of what they have to deal with. But when you cross train, you have the ability to start divvying up things and not have to bring more people in. But more importantly, what I was very proud of that we were able to do at Carroll Mortgage is to rarely ever have to lay anyone off because you don't during when the volumes pick up, you just pay the overtime. You've already got the staff that's highly staffed. You get it done. But that way, you don't hire just to handle that volume, which everyone was hiring, and everyone was looking for people in 2020 and 2021. But that way, you don't have to do it when it slows down, then start laying people off. Because then at that point, you can start stretching things out and say, hey, I need you to start focusing on this task or this project. And with that cross training, it helps. Or worst case scenario, if you have someone just up and quit and not give you 2 weeks notice, you've got someone that knows a little bit about that department.
I've always admired your ability to incorporate, or I should say, just capture everything that a traditional mortgage lender has: the appreciation of underwriting, the appreciation of branding and local community, and the appreciation that every mortgage does have a story. And You're one decision away from making sure that you didn't make a fraud or a bad loan, but you're also one decision away from helping a family build generational wealth that compounds and maybe would have been too big of a barrier if they didn't run into you for the occurrence.
No, I totally agree with you. In fact, one of the things, number one, I always told people, I never told anyone I can't do a loan for. I've always said I can't do a loan now. Here's what you need to do, and then come back at this on this time frame, because ethically you don't tell someone you just can't do the loan. You need to tell them what they need to do to become a homeowner in the future. Because sometimes you got people that are coming in, they can't buy a home. They just want to know what they need to do to be able to buy one in the future. Or better yet, you got one like I'll never forget. There's a very large hospital system here in Arkansas, throughout the state, and the head of their home human resources department, who was making about 300,000, not 300,000 a year, but she was making really good money, and she came to me, was referred to me, wanting to buy a home. She goes, but look, I have an ex-spouse that pulled me into a bankruptcy, and I know I can't buy anything now, and but I want to be able to buy something for my daughter and I in the future. And I said, well, wait a minute, what type of bankruptcy? Was it 12? Excuse me. I found out. I said, "Are you?" Sorry, somebody was walking right outside my window and was trying to wave at me and caught me off guard. But no, I said, "Are you in a payment plan?" She said, "Yes." I said, "Have you made 12 monthly payments?" She said, "Yes." I said, "What's the payment that you're paying?" She gave it to me. I looked at the numbers. I said, "You can totally buy a house now. You just got a bankruptcy court approved. We can take you FHA." And she was tickled pink, and she bought a house for 300 something $1,000. So, I mean, it's a matter of trying to make sense of things for people. And one of the things I've learned about with underwriting that I really appreciate from my father, what he taught me was rule number one of underwriting: throw away the credit score. It's not worth the paper it's printed on. In fact, the last year that I was underwriting under the Carroll Mortgage umbrella, I remember I denied I approved a loan that was at 580. And I denied a file that was a 666. And I remember that because the number of the beast. But here's the difference: the borrower with the 580 has great credit scores. Excuse me, great credit history, except for 2 delinquencies in this year. And we are now, that credit report was like in September. He had 2 delinquencies ever on his report, but they were that year on a new account he had just opened. Credit explanation letter said, I opened up a new account. The first payment I made to them, I didn't know they waited 10 days to draft my account, so I was insufficient funds when they drafted it. And I didn't know that was their policy. So then the second time it happened, and he stated the month, it was like May. He goes, from there on, I quit paying that way. He'd made payments like clockwork since then. But more importantly, and what I always care about, underwriting is based on, does the borrower have the ability and the willingness to make the payment? I said, I want a verification of mortgage or rent. He was paying $300 more than what our mortgage was going to be, with no delinquencies for the past 36 months. Does he have the ability and the willingness to make the mortgage payment that's $300 more than his rent? Well, yeah, clearly. More importantly, he was straight salaried. Now, the credit score was crap. In fact, I even took it to a couple other underwriters. I said, no, that credit score is wrong. But the credit risk analysis of the borrower is great. Now, the 666 score, truck driver, most recent year, workers' comp, decreasing income, not 20%, but it's decreasing. The other thing, housing shock. His housing payment was going up $1,100. Now, which loan do you think's a better deal if you take away the credit score? The 580.
I mean, makes sense underwriting depending on who you are, use the 3 or 4 C's of lending, right? Credit, collateral, capacity to pay, and sometimes character. It makes a lot more sense to stick to the C's of lending rather than, hey, let's see if we can fit into this box. Speaking of the box then, so why would it make sense today to be a mortgage startup when in the past we had seen negative profitability from the average IMB to today, where still there's some hope on the horizon? So why would somebody who's a smaller, maybe a broker, want to say, I want to be an IMB? Or why would you start one up just as a generality today? Can you go deeper into the mindset so that if you're an originator and you're looking at, well, I could do this on my own, or I can go to someone who's doing a startup, but I want to get paid. So how does someone look at it from an originator standpoint and from an owner standpoint?
Well, from on the owner standpoint, the bank realized this is a good time to start it up. because of the fact that you can pick up people on the cheap because there's so many people on the street. Essentially on the plus also the banks have the mindset eventually rates will be going down, which will bring a little bit of a refinance market there. Then in regards to an originator, why would you want to go to a startup? Well, I mean, I'm just now starting to bring in, because I didn't go live with the mortgage operation until fourth quarter. And I've told them, I said, this has got to be a crawl, walk, run. There was a true mortgage startup. Alabama and here were both true startups. They had no HUD lender ID. So I said, I'm going to have to do all your policies, procedures, get the HUD lender approval, got to get the VA, get USDA. I'm going to have to get, there's no LOS. So I've got to get that set up. And then I mean, it is a true startup. I said, so once it's started up, then I'm going to got to run a few loans here and there and find the problems and fix them so I can close loans and make closing deadlines. Because if you've got a big, huge pipeline, you're not going to be able to do it. But more importantly, if you start bringing in producers and you're having a problem closing their loans, well, you guys know you've only got one shot with with loan officers. If you're not closing their loans, they're going to walk right back out the door and they're done. They'll never come back again. So I'm just now wanting to start. We've already been walking. Now I'm ready to start jogging. So I had an interview with a loan officer yesterday, and that was the thing I told her. I said she was talking about maybe going to a bank here that's established that has a mortgage operation. And I said, well, the startup here. I said, you get to deal with me. And I said, directly. I mean, I said, I was on the phone the other night at 8:30 at night, explaining to the selling side how to structure the deal to get the deal worked out, to make it work. And she sat there and said, well, very smart lady. Did I ask this question? She goes, well, how are you going to do that when you grow it? And I said, that's a very good question. I said, well, I'm starting out from very, very small and growing. So I'm able to train people the way I want them. And in fact, the person I brought in for closing, who's been a closer for over 10 years, finally one day goes, Jim, I finally figured it out. You're not a micromanager. You're just wanting me to train it the way you want it done because it's the right way. And the reason why she said that was the first two test cases we had with HUD went through HUD. They pulled it and underwrote them, endorsed them in less than 72 hours. And then the person that's assigned to us even said, hey, look, these were really clean files. Y'all are doing a great job. So she sees the reason why I want it done a certain way, because if you do it the right way, unless there's fraud, you're not getting that loan back.
Is perfectly, I think, the perfect story for how you start to build and execute, especially in this market, and you don't get over your skis and want to be somewhere where you're not yet, which some tech vendors do. And I think Mike has a good question on the other side of this quick commercial break from our vendors, and we appreciate Mortgage Connect and their ability to deliver, especially since they control a lot of like the last thing a customer remembers, that closing table, and ADM software, which is a emerging tech because they've already been established with their ability to handle data in ways that others can't. A lot of people have been jotting down that name. So let's hear from our sponsors quickly.
Want to take your business to the next level? As a longtime trusted mortgage service provider, Mortgage Connect works with some of the largest lenders, servicers, and institutional investors, providing cutting-edge solutions for everything from title, closing, escrow, and default to capital markets and risk solutions. Mortgage Connect brings it all to the table, redefining mortgage lending with innovative digital solutions that can elevate your bottom line.
It's time to use AI to revolutionize the way you do marketing in 2025. With ADM Intelligence, we have access to 5,000 consumer data points and proprietary AI technology that helps you understand who is in your database, what's the likelihood of people to do a real estate transaction, and also who they are. So for example, someone who's 50% likely to transact the next 6 months, who's a first-time home buyer, should receive very different content than someone who is, let's say, not as likely to transact that already owns a home. And of course, our content team will provide you with all of that turnkey out of the box to market to everyone in your database. So to learn more, come find us at ICE. If you're there, we're booth number 327, or go to our website, thinkadm.com. Love to walk you through a custom demo of how AI can supercharge your marketing this year.
Awesome. Jim, as I listen to you speak, and if I'm coming to you as a recruit or an originator, and to put it into context, I don't think that the average originator actually knows how to ask the right questions based upon your experience. And I think I say that because number one, you went through 4 audits. It didn't have any issues. And so an originator comes to you, goes, and all they're concerned about is really getting paid. But then when I listen to you in the second half of our interview, you're talking about the C's of lending: credit, collateral, capacity to pay, and character. And then you can sit here and go, wait a second, as a recruit, maybe we're a younger origination shop, but let me tell you something. I've been through 4 audits. And on top of that, as in experience as a leader, and on top of that, I also believe in make sense lending. I don't think the average originator actually knows how to do that. How do we convey that to any other originator that doesn't necessarily know who you are, or when you're going to be expanding from the Midwest into either the left or the right coast? And as you go through expansion, how do you convey that as the message of your background and not just the bank itself? Because your leadership can actually take leaps and bounds to another originator's, not only in units and productivity, and also in improvement of the quality of the way they also do business as well. So how do you do that and convey that message to the originator?
Well, to the originator, I'd always tell them that, like, especially when they're, like you said, if they're a new originator. Well, guess what? Most realtors do business with people they like. Now, once again, when they give you a contract, they're giving you a paycheck. They're giving you a paycheck. They expect you to cash it. Now, realtors are going to do business with people they like, but more importantly, they're going to test you to see what knowledge you have. They're not going to expect you to know everything, is what I tell them, because you are new. They're going to see how quickly you can get the answer they need, because that's where you can tell a difference in the mortgage operation that the loan officer's at, is how quickly they can get the information from the person who has the answers. That makes a difference. And that's where I've always, that's why I still, even though I'm employed by a bank, I still treat it as if I'm self-employed. Last year in 2024, I came on board in April of 2024 to start this thing. And then in I worked every holiday and every weekend to get it up and running, just because I have that work ethic of being self-employed. I've been assigned this task. I gotta complete it. But in fact, I've told loan officers, the main thing is how quickly you can get the answer, and how much support you have from the senior staff. I've actually taken on 2 Thanksgivings loan applications for loan officers who were unavailable, just because from being self-employed, I know you got to strike when the iron, from being a loan officer, I know you got to strike when the iron's hot. Not only that, if someone's writing an offer on Thanksgiving, they're not wasting your time. If they don't buy on that day, but they're going to be very impressed that you took the time to help them on that day. So that's the main thing, is to try to find out, when you're inquiring as a loan officer about different shops you want to go in with some questions and see how quickly they can get you those answers. Because typically you're going to be dealing with a sales manager. So I would come in with some hard cases of how would y'all handle this loan or this loan, and see how long it takes before they can get back to you with, this is how we would structure it. Here's what we would do. Because communication to me is key to everything. And that's why, like I've told people before. In fact, when I was talking to that seller side, I told y'all about the other night at 8:30. I told the buyer's agent, I said, get me a letter from the borrower saying I have full access to talk to the selling side. Then I got the seller on the phone and I explained everything, because then it's not the underwriter telling the processor who's telling the loan officer's agent, or excuse me, the borrower's agent who's telling the seller's agent who's telling the seller. It's coming straight from the underwriter. Hey, here's the problem. Here's how we can fix it if we do X.
We appreciate a little segue there of being able to talk a little turkey with you, Jim. This is about coming on two full years now of doing this every Thursday live at 2 p.m. Eastern. We haven't wavered on it, except the 2 Thanksgivings we've taken off. Next Thanksgiving, we'll have you host the show for us. We appreciate that.
There you go. It'll be the best episode you've ever had.
It'll be the most viewed, that's for sure. And if you like this, please give us a like, a subscribe on our YouTube station. If you're listening on one of our audio podcasts like Spotify, Apple, Amazon, or anywhere else, please give us a like as well. I want to segue into one current event while giving you another compliment, another flower as our guest. I think our industry gets very trained because of the way Fannie and Freddie's DU system is set up, where it's almost gamified to try and get somebody qualified. Almost if you were good at video games growing up, maybe you can get into this DUNP, put in the right info and try and get that approved eligible. And then if you have a culture that's built on sales and leveling up, it's about how many can you get in there, how many can you get approved, how many can you move. And I think the further you get away from the fact that these are serious vehicles, very regulated by the federal agencies if you're going through it, and you can lose sight of some of the penalties that go along with it, what type of game you're playing if you don't have a leader like Jim Carroll. So when HUD tweeted out just a couple hours ago that they are now going to be looking at occupancy fraud, which if you followed us, Michael Zhao and his family office of 1031s and burst 1031s and fix and flips has been talking about careful of these 203Ks as potential occupancy frauds for a long time now. Nobody in particular, but I could see somebody playing that game, trying to get the approved eligible and losing sight on the big game that they're playing, the big purpose that they're playing. So I appreciate how you do that, Jim. What advice would you give to lenders, maybe seeing that tweet on anything they should react now or any new culture initiatives they should do as a wake-up call moving forward?
Or in regards to occupancy fraud?
The fact that it's been a while since the agencies have come out and said something as alarming as, hey.
Yeah, I think that what you're starting to see over the last few years, there has been fraud for housing. And because of that, in fact, I even knew someone that told me that's basically what they did. Luckily, they didn't use me as their lender, but they actually had someone that was a friend put them on salary at their office just until they got the loan approved. And then they went back to their regular self-employed job. I mean, how do you combat that? I mean, that you can't. I mean, it's about risk analysis. I mean, essentially, you're taking a gamble on someone that's newly employed. You're going to be doing that. In regards to risk for occupancy, you're just going to have to look to see if there's anything there that doesn't make sense. That's the only thing you can do.
But I think as a culture, you maybe putting in some places where you get rewards as a loan officer for spotting fraud, right? Like very few places, instead you just lose out on that. Maybe you're one deal away from going to President's Club, right? And maybe just a little bit of an extra pat in the back. Like we know you could have tried to get it into Fannie Mae. Good job asking the extra question. Because I'm sure a lot of these could be figured out if you ask one more question, right?
Yeah, and I agree. And that's what if you know your loan officers, you can, if it's a manual underwrite, I would always call them in. If I was a real iffy feeling on it, I'd call the loan officer in and I'd ask them, I said, do you think they'll make the payment? And I actually had some loan officers go, no, I don't think they would. I mean, that's why it's important to try to, and that's what I remember when I was starting this up and I was trying to look at bringing somebody on it for a position I needed. Someone in the bank goes, hey, do they have to have mortgage experience? I said, absolutely not. I said, I want to train people. I don't want them to already have bad habits. I said, she goes, well, what do they need? I said, a moral compass, business ethics, and the ability and willingness to learn. I can't teach those. And I mean, I can train anything else and I can work with anything else. So that's why it's very important to the staff you got. I mean, and that's why when you're vetting, you're bringing on a loan officer, you want to maybe check with your realtors in that community if there's a reputation with that loan officer. Because what you'll find is there's some loan officers that may be a top producer, but if you got a good trusted realtors in that market, they'll say stay away from them.
Yeah, and if I can jump in one more time, I hate to take this question from you, Mike, but people say, where are the loan officers going? Like, they could be replaced, and look at all this new AI like you're talking about, Jim, and you could train AI to stop fraud. The bad actors can also train AI to trick the AI that's stopping the fraud. I attended and I know the CFPB's sort of suppressed right now, but next person up. When they were asked on stage at the New England conference, what do you guys think of AI? They said, we have no comment on it other than, and we're all for it, other than if your AI makes a decision or chat something in a bot, you will be under the same penalties as if a as if a person chatted or made that decision. So it's something to consider if you went all digital AI and AI couldn't pick up on that fraud. That could end up going back up to the owner who put in that software. I think that's going to be a finger point in the future
Right.
where
That's why I don't believe you're going to replace a lot of the jobs. I mean, you're always going to need the person, a physical person to do analysis sometimes. 'Cause like you said, software programs can be tricked. Um, for example, typically, if you get to a certain ratio on conventionals, it's automatically going to flip to a refer from an approved eligible. So you know what you got to do to try to make that work, things like that. But yeah, I mean, that is the truth. With all the technology out there, it can be scary to try to put all your faith into it. I've never ever trusted computers completely.
Yeah, I was speaking to an originator in the Midwest about a year and a half ago, and he said, "Hey, Michael, this if you have uh, he just told me it was a high debt to income ratio and so on and so forth." And he goes, "You know what I did to fix it?" I said, "What'd you do?" He goes, "I changed the race and national origin to X. To I don't want to promote bad behavior, and then guess what? Because I changed the race national origin, got a approve eligible." I said, "You're kidding me? Show me, show me how you did that." And he said, so he showed me, walked me through the steps, and just through change. And this is, he was the bar was a certain race, changed it to another one. And I'm like, and sure as night turns to day and day turns to night, approve eligible. I couldn't believe it. And when I see things like that, it's amazing. I can't even believe that. I would never even thought of doing something like that.
Oh, that's
Just
why
changing that.
whenever I would underwrite a file, a lot of times I look to see how many DU submissions have been done, because that means they're just doing anything and everything to try to get it approved. you know, so then that's when you're like, okay, we've got a gazillion submissions. I'm going to have to look for some landmines here.
And I think that's part of like where the world's going and that's what I was trying to say earlier. When the old way, and if you want to take us down memory lane, Jim, you can, but you'd have big stacks of files, signatures. That tells you it's important. When you're clicking and then almost like playing the game, meaning it spins and says yes, no, your mind accidentally goes back to games you grew up playing on the iPad. I'm talking about the younger ones, right? And if there's no real human element, there's no paper, there's no signatures involved, I think, and no humans, I think that's a pressing point why we might go a little bit this way. And then almost, even if it's a little more expensive to produce a loan, have to get humans back involved to remind everybody these are serious instruments backed by the federal government and important in cultures like yours, Jim. That's why we wanted you on here, to remind everybody you can have forward facing tech and why people reach out to you, because it should be underwriting first. But at the same time, you need an old school culture that appreciates what a mortgage note is. And
Yeah. And to address what you mentioned earlier about how do you deal with to prepare yourself for that fraud potential of fraud for occupancy that I just made a note of today, it might be a case that you may want to have your fraud document, that's punishable by $1 million fine and 30 years in prison, separate from all the disclosures you send out. And that way your loan officer goes, "Hey, you signed all these disclosures, but I want to make sure you understand this one document here." And because there had been times where we had a borrower that we thought was committing fraud and would go over with them, "Hey, look, you sign this one initial disclosure, states that if you commit fraud, you can go to jail up to 30 years and up to $1 million fine." And boy, they would start telling you the truth right then and there when you'd point that out. Because when they go through all those disclosures, they're not looking at them. I mean, that you can send 50 plus pages of disclosures out for e-signatures and they'll come back in a matter of minutes. They didn't look at anything. They just click, 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 click. But if you point that one out to them real quick, I think that will put a very strong emphasis on don't commit fraud on me.
Do you think that working for a bank, it's going to be easier for originators with you at the helm, instead of looking at you as an actual FDIC insured bank? They're going to be able to look into you as if you're an IMB, which you are, I guess, on an actual basis, independent mortgage FDIC banker. Do you think it's going to be easier for the originator to come to you and say, "You know what, we're going to do make sense lending as an FDIC insured bank. We're going to act like an IMB, except you're going to get the same service as an IMB, even though we're with a bank. Because if you go with an FDIC brand name, you're going to be in a little bit more, maybe a little bit more stringent in the guidelines with the whatever, and I forget the name of the federal group that legislates FDIC insured banks. But you're going to have some underwriting issues as an originator, and I think that you're going to. Are you guys going to be doing some DSCRs and non-QM also as a part of your bank?
Well, first off, I told her I'm not going to be doing any non-QM. All that is to me is subprime all over again. They just changed the name of it. Not to insult anybody in that business, but number one. But number two, typically I don't like files that I don't underwrite because when it goes out of the office, everybody's always beating you up, wanting to know what the status is and everything. But non-QM, I don't have a real big taste for. The DSCRs, I'm not doing them yet, but I probably will be because, Fannie and Freddie have really pulled out of the investment market. So, I mean, it's, I need to look into that. But in regards to the FHA, VA, USDA, Fannie and Freddie, I don't have any overlays. I'm underwriting to what the agency guidelines are. That's what got me through the 4 HUD audits was I didn't have any of these. I just wrote to the agencies and then they would come back and say, well, why did you do this? And I would say to HUD, I'd go, show me your handbook where it says I can't do it. For example, I remember on one with one of HUD's audits, they came back, they said, we see that this was a manual underwrite. And that section such and such of the handbook where on that it says there's 3 things required. I went, I'm an underwriter and I don't require all 3 things being required. So I reply back, I go, you are correct in section such and such. On page of the handbook, there is 3 bullet points. After bullet point number 2, it says or not and. Big difference in that one word. And that's what I try to point out to loan officers. It's about the wording. You need to read things because a lot of loan officers don't read the DU findings, and that's very important. Now, sometimes, don't get me wrong, the DU findings will just direct you to the selling guide of the handbook, but sometimes there's verbiage in there that you can catch right off the bat that is an issue that you didn't address right then and there. Like, for example, one of the things with this software that I'm using from Friday Harbor, I was like, are you able to flag when the credit report's about to expire? And they said, well, sure. Why does that matter? I said, well, I can't tell you how many times I had a loan officer walk in my office and go, got a slam dunk deal, got the contract, locked it in. I said, well, you didn't read your DU findings. The credit report expired a month ago. You're going to have to pull new credit. Hope you even have a deal. And then on top of that, see if we can still keep the price in there. So it's a matter of reading those things. That's the key.
If you're an IMB leader, and I'm listening to this conversation, one of the issues has been when the agencies come back and say, you got to buy this loan back. And you go, wait a second, this follows DU guidelines. Do you think that with the way that you have trained your operations staff, is there a more efficient way for IMB leaders to look at their operations and say, this is how you can reduce or mitigate the amount of buybacks from the agencies in the way that you have trained or taught your current operations staff so they can reduce those buybacks from the agencies?
Yeah, with the buybacks with the agencies, the main thing you've got to make sure is just because they're coming back telling you something, you may want to make sure that they're asking the right questions and don't just assume it. Just like HUD was wanting me, that they're going to want me to indemnify that loan because I didn't have the 3 things, but I went and looked it up and said, oh wait, you're wrong. I don't have to have all 3. I just got to have 1. The other thing is documentation. Always keep it. You may not deliver it all to the investor, but if it comes up later on, sometimes I'll tell people I want X, Y, and Z. I don't need it for the file per se, but later on down the road, they may want it, and I want to have it in the file in case we need it. Because sometimes or for example, I had one. I'm a notorious pack rat. I keep when I was an originator, I kept everything, and I remember after the subprime meltdown, Citi around 2011 or 12 came back wanting us to buy back a loan because there was not a bank statement for that file from 2005. Guess who had documentation that said file from 2005 and had that bank statement?
You. Gen Z does not pack rat, but you're, one for the Gen X, one for the millennials of the world. the last pack rat generation. I have a final question because I know we're running up on time here. I'll call it, and just for any listeners out there, I don't plug it very often, but Adopt the Brand is my company. It's a door opener matchmaker for any mortgage vendor that the lenders maybe don't know about, making those introductions to people like you see our guests on our show, looking for fintech, prop tech, new stuff, especially top of the funnel with large customer bases would be cool. I plug that because my question actually has to do with that. And the vendor startup, lender startup or not, but the vendors, let's do this one. The vendor startup and then the Jim Carrolls of the world that would love to help everybody, but obviously doesn't have time to help. That dance, right? You've been in this dance. What would you recommend to, I guess, both sides of where the dance makes sense and where to look out for pitfalls or where it's okay to maybe separate ways when they start stepping on each other's shoes? And usually that is, you think a launch is supposed to be in 12 months. Now it's 18 months. Now it's 24 months. And where does a lender want to be ahead of it and bet on something coming out? And then where are there pitfalls of kind of betting and dancing too long, dancing to that Evans song by Bryan Adams, like where it's a 9-minute song and you're like, I didn't sign up for this dance.
Yeah, and that's, if I understand your question correctly, dancing with a new startup vendor, they just got to be honest with you. When I was starting up the mortgage operation in Alabama, we were approached by a new LOS system, and they wanted us to help consult on it. Well, and help them build it. We were meeting with them twice a week, going over things, giving them input, insight, and they kept telling us, "Okay, we're going to be ready by this date." We weren't ready. It first started out where they were going to be ready by the summer, and then then it was going to be September, then it was going to be November, and it kept going on and on. It's a matter of being realistic in your expectations and telling people what you really believe that you can do.
That was a great, concise answer. Shorter than my question. Mike, any final questions? I know you underwrite some deals for your family, for the family office. So you have an appreciation for our guest today, but any final thoughts here? Or
I don't necessarily have a question. However, Jim, just like Mike said at the beginning of the show, 4 audits, no buybacks, collateral, capacity, character, credit, makes sense underwriting. It all resonates with me, not only as someone who goes and buys mortgage loans, but also as someone that wants to reduce the amount of buybacks and litigation in every single mortgage loan. And when you put that together with your track record and taking into consideration that, and you're saying right now is the perfect time to start a mortgage company. And when you start a mortgage company and set it up right and put it together and say, I'm going to reduce the amount of fraud, I'm going to reduce the amount of buybacks, and this is how I did it over the last 30 years of my career, not only is that an accomplishment, it says something to how you're starting the company. So it has longevity, not only for the company that you're starting, and also for the originators who are coming into a system that has already worked as you're starting to put it together. So Jim, thanks very much for not only giving us the history, but also the mindset and the thought pattern behind that. It's impressive that you can not only do that in the past, however, and also put it together for future, not only for the bank itself, but future originators who do come into your presence, into your system, and also for the improvement of their origination processes as well. Thank you so much.
Well, thank you, gentlemen. I greatly appreciate y'all letting me share my story with you.
Thank you for joining us on this journey into the heart of mortgage innovation. Remember, every mortgage has a story, and we're here to help you write yours. If you enjoyed today's insights, please subscribe, share with your network, and connect with us on social media. Until next time, keep pushing the boundaries and uncovering the stories that drive our industry forward.